Welcome to your practice review for the WGU Financial Management II exam. We'll explain what makes each answer correct, why the alternatives fall short, and the principle behind every question. Today's Domain 1 covers capital structure and leverage, including ideal debt to equity structure, book value versus market value approaches, operating income volatility and business risk, operating leverage and its degree, financial leverage and its degree, total leverage and its effect on EPS. Our website provides free exam guides plus a wide range of practice questions to help you get fully prepared for your D365 exam. Everything you need is just a click away. You'll find the link right down in the description below, so be sure to check it out and start studying smarter, not harder, today. All right, let's dive in. Question 1. A firm's chief financial officer describes how the company paid for its factories, delivery trucks, and equipment. Roughly 40% of the money came from bonds and bank loans, and the remaining 60% came from common stockholders. This 40-60 blend of borrowed money and owner-supplied money is best described as the firm's what? Your options are operating break-even point, B, degree of financial leverage, C, capital structure, D, working capital cycle. Which one is it? Pause the video if you need more time. The correct answer is C, capital structure. C is correct because capital structure is the specific mix of debt, preferred stock, and common equity a firm uses to finance its assets, usually stated as percentages of total capital. A 40-60 debt-to-equity blend is exactly that mix. A is wrong because the operating break-even point is the unit sales level where EBIT equals 0, not a description of how a firm's assets are financed. B is wrong because the degree of financial leverage measures how much EPS moves when EBIT moves. It is a sensitivity number, not the financing mix itself. D is wrong because working capital concerns short-term current assets and liabilities used in daily operations, not the long-run blend of debt and equity funding. Capital structure is the mix of debt, preferred stock, and common equity a company uses to fund everything it owns. Every asset was paid for either by a creditor expecting repayment with interest or an owner hoping for future profits, and the split between them is usually expressed as percentages of total capital. Debt is contractually cheaper because lenders get paid first and interest is tax deductible, shifting some cost onto the tax authority. But debt is rigid since interest and principal come due no matter how the year unfolds. Equity costs more because owners stand last in line, but it's flexible since a dividend can be trimmed in a hard year without triggering default. Picture a mid-sized industrial parts maker funding a new plant. Issuing bonds locks in a fixed interest bill that flatters earnings in good years but bites hard in a downturn. Issuing shares dilutes owners and forgoes the tax break, but lets the company ride out hard times without a banker demanding payment. Students often confuse this with working capital, the short-term juggling of inventory and payables, or the capital budget, which decides which projects to fund. Capital structure sits one level up. It's about where the money for the whole enterprise comes from, always signaled by a split, like debt versus equity as a share of the total. Neither an all-equity nor a heavily indebted company is automatically right. The answer depends on how stable the business is. That single tension between cheap, rigid debt and flexible, costly equity is the heart of capital structure. Question 2. A company's treasurer weighs two financing sources. One carries a lower required return and lets the firm deduct its payments from taxable income, but it must be paid on a fixed schedule no matter how the year goes. The other carries a higher required return and can have its payments cut or skipped in a bad year without triggering default. Which statement correctly identifies these two sources? Your options are A, the first source is debt and the second is equity. B, the first source is equity and the second is debt. C, both sources are forms of debt with different maturities. D, both sources are forms of equity with different voting rights. Take a second. Which answer would you pick? The correct answer is A. The first source is debt and the second is equity. A is correct because debt carries a low required return and tax-deductible interest but a fixed must-pay obligation, while equity costs more because shareholders bear more risk, yet its dividends can be reduced or skipped without default. That matches the first source and second source descriptions exactly. B is wrong because this reverses the two. Equity is the costlier, flexible source, not the cheaper source with a fixed payment schedule. C is wrong because only one of the two is debt. The flexible source whose payments can be skipped without default is equity, not a second form of debt. D is wrong because only one of the two is equity. The cheaper tax-deductible source with a fixed payment schedule is debt, not a second class of stock. $2 raised from a lender and $2 raised from a shareholder can buy the exact same machine, yet inside the company they behave like completely different animals. One comes wrapped in a fixed promise. The other comes with no promise at all, only a claim on whatever is left over. Debt is cheaper for concrete reasons. Lenders sit ahead of owners in line, so they take less risk and accept a lower return. And because interest is tax deductible, part of every payment comes back as a lower tax bill. Equity sits at the opposite end. Common shareholders are residual claimants paid only after employees, suppliers, lenders, and taxes are settled. And standing last in line means investors demand a higher return to compensate for that risk. Picture two identical distributors hit by the same drop in orders. The bond-heavy one still owes its full interest bill and may have to scramble for cash, while the stock-heavy one simply suspends its dividend and waits out the storm. Cost and flexibility always trade off. A fixed schedule and default risk point to debt, while skippable payments and no maturity point to equity. And spotting which pressure a scenario emphasizes tells you which one you're looking at. Question 3. An analyst explains why lenders accept a lower return than stockholders on capital they provide to the same company. Which reason best supports why debt is generally the cheaper source of financing? Your options are: A. Lenders are paid last, only after common shareholders receive their dividends. B. Interest payments are set by shareholders each year and can be skipped at will. C. Debt never has to be repaid, so it costs the firm nothing over its life. D. Lenders are paid before owners and interest is tax deductible, so they accept a lower return. Before I reveal it, which one do you think is right? The correct answer is D. Lenders are paid before owners and interest is tax deductible, so they accept a lower return. D is correct because debt is contractually cheaper because lenders have a priority claim, getting paid before owners, and because interest is tax deductible, which shields part of the firm's income from taxes. Lower risk plus a tax advantage lets lenders accept a lower return. A is wrong because lenders are paid before shareholders, not after. That priority claim is precisely why they accept less compensation. B is wrong because interest is a contractual obligation on a fixed schedule, not a discretionary payment shareholders reset each year. Dividends, not interest, are the skippable payment. C is wrong because debt must be repaid and interest is a real expense. The claim that debt costs the firm nothing over its life is simply false. Why would any lender accept a smaller return than shareholders earn on the very same company? It looks like a bad deal, but it happens everywhere in corporate finance. Two features explain it: where the lender stands in line and how taxes treat interest. First, priority of claim. Interest and principal get paid before any profit reaches owners, and in liquidation, senior creditors get made whole before shareholders see a cent. Lower risk for the lender means a lower required return. This Q is not negotiable. Lenders are protected by their place in line, while shareholders absorb whatever risk is left over. The second piece is taxes. A company deducts interest expense before calculating what it owes, but dividends come out of after-tax dollars. That's why a loan stated at 8% might really cost a firm in the 25% bracket, only about 6%. Put the two advantages together and debt's cheapness stops being a mystery. Lenders risk less, and the tax authority absorbs part of the cost. But that same priority forces the borrower to pay on schedule or default, so cheaper never means safer. Question 4. During an investor call, management states that it intends to keep about 35% of its capital in debt and 65% in equity over the long run, and that it will lean toward whichever source moves it closer to that mix whenever it raises new money. The stated long-run goal is the firm's what? Your options are A. Book value capital structure, B. Target capital structure, C. Operating leverage, D. EBIT, EPS, and difference point. What's your answer? Commit to one before I continue. The correct answer is B. Target capital structure. B is correct because the target capital structure is the debt-equity mix management aims to maintain over the long run and uses as the reference point for financing decisions. A stated intention to hold 35% debt and steer new financing toward it is exactly that. I was wrong because book value capital structure is a backward-looking measurement taken from the balance sheet, not a forward-looking policy goal management steers toward. C is wrong because operating leverage describes the share of fixed versus variable costs in the cost structure, which is unrelated to a target financing mix. D is wrong because the EBIT EPS in difference point is the EBIT level where two financing plans tie on EPS, not a stated policy goal for the debt equity mix. When a CFO says the firm intends to hold roughly 40% debt and 60% equity, that is not idle talk. It's a stated target capital structure the long-run debt to equity mix management has chosen and will steer toward. Financing decisions happen one at a time, so the target gives them a common direction. A firm below its target debt weight leans toward borrowing next. One above it leans toward issuing equity or paying debt down, closing the gap gradually rather than all at once. A common mistake is assuming the target minimizes one thing. If risk alone mattered, the target would be zero debt. If short-term earnings alone mattered, it would be loaded with debt. Instead, the target balances debt's cost advantage against its added risk, aiming for long-run value. Picture a grocery chain targeting 1/3 debt. After strong cash flow, it pays down loans and drifts to 1/4 debt, below target. When it next funds a distribution center, it issues a bond instead of stock, nudging the mix back up. The target is a forward-looking goal management can revisit, not a permanent rule or a description of today's actual mix. Whenever a scenario describes a stated long-run intention the firm steers toward, that's the target capital structure at work. Question 5. An exam item asks what the word optimal means when it is applied to a firm's capital structure. Which description correctly captures the optimal capital structure? Your options are A. The mix that maximizes the firm's share price, equivalently the mix that minimizes its overall cost of capital. B. The mix that carries the least possible risk, which usually means no debt at all. C. The mix that produces the highest possible earnings per share. D. The mix that maximizes the total assets reported on the balance sheet. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is A. The mix that maximizes the firm's share price Equivalently, the mix that minimizes its overall cost of capital. A is correct because the optimal capital structure is the debt-equity mix that maximizes share price, which is equivalent to minimizing the firm's overall cost of capital. It balances debt's cost advantage against the added risk that debt creates. B is wrong because the lowest risk mix would usually mean no debt, but that is not optimal. Some debt lowers the cost of capital and raises share price, so zero debt leaves value on the table. C is wrong because the EPS maximizing mix is a classic trap. It carries more debt than the value maximizing mix because it ignores the rising risk that heavier debt loads create. D is wrong because capital structure concerns how assets are financed, not how large the asset base is. Maximizing total assets is unrelated to the optimal financing mix. In capital structure, the word optimal has one precise meaning: the debt-to-equity mix that maximizes share price, which is the same as the mix that minimizes the overall cost of capital. Exam writers love this word because its everyday meaning misleads you. Optimal is not the lowest risk structure, since zero debt forfeits the tax benefit of borrowing and usually leaves price lower than it could be. And it's not the structure with the highest earnings per share, because EPS keeps rising even after too much debt has already dragged the stock price down. A stock's price reflects both expected earnings and the risk-adjusted return investors demand. So it's the one number that captures both the benefit and the cost of leverage at once. That's why maximizing price, not earnings per share, defines the true optimum. As debt increases, cheap tax-favored debt initially lowers the blended cost of capital, but past a point, rising risk pushes that cost back up. The debt level sitting at the bottom of that cost curve is exactly the same level sitting at the top of the price curve. Optimal is a value word, not a risk word or an earnings word. If a question frames the goal as maximizing price or minimizing cost of capital, it's describing the optimum correctly. If it frames the goal as the biggest possible EPS, it's baiting the classic trap. Question 6. A heavy equipment manufacturer that makes bulldozers and mining trucks finances part of its factories with fixed rate debt. An instructor calls this debt a rocket booster in good times and an anchor in bad times. What single feature of the debt makes both halves of that statement true? Your options are: A. The interest rate on the debt rises and falls together with the company's sales. B. The debt converts automatically into equity whenever profits fall. C. The interest charge stays the same dollar amount whether operating profit rises or falls. D. The principal is forgiven by lenders during recessions. Which would you go with? Lock it in before the reveal. The correct answer is C. The interest charge stays the same dollar amount whether operating profit rises or falls. C is correct because the interest charge on fixed rate debt does not change with operating profit. When EBIT grows, that fixed charge lets extra profit flow to a fixed pool of shares and lifts EPS. When EBIT shrinks, the same unchanged charge consumes a much larger slice of a smaller profit pool. One fixed charge produces both effects. A is wrong because if the interest rate moved with sales, the charge would shrink in downturns and the anchor effect would vanish. It is the fixedness of the charge that creates the dual nature. B is wrong because fixed rate debt does not convert into equity when profits fall. The obligation to pay interest remains, which is exactly what makes it an anchor. D is wrong because lenders do not forgive principal in recessions. They still expect full payment on schedule. That unrelenting claim is the source of the anchor effect. One feature of fixed rate debt explains why leverage feels like a rocket booster one year and an anchor the next. The interest charge never moves. It is locked in when the debt is issued and stays the same dollar amount no matter how the business performs. Think of the fixed interest charge as a fixed weight bolted to a lever. It doesn't care which way operating profit moves, it just amplifies the swing, turning a modest change into a much bigger one for shareholders. In good times, operating profit grows but the interest bill doesn't, so the surplus for shareholders grows even faster and earnings per share jump. In bad times, the same fixed charge eats a bigger slice of a shrinking profit pool, so earnings per share fall even harder. Picture operating profit as a bar with a fixed interest block sitting on top of it. Because that block never changes size, whatever's left over for shareholders stretches or shrinks disproportionately as the bar rises or falls. The key nuance is that it's the fixedness, not debt itself, that does the work. A floating rate that fell in downturns would soften the pain, and one that rose in booms would blunt the gain. The constancy of the charge is what turns leverage into a multiplier of whatever trajectory the business is already on. Question 7. During an economic expansion, a cyclical manufacturer watches its operating profit climb sharply while the interest expense on its fixed rate debt stays flat. What happens to its earnings per share and return on equity, and why? Your options are A. They fall because the fixed interest charge grows faster than profit does. B. They rise faster than the underlying business grew, because a fixed interest cost lets the extra profit flow to a fixed share count. C. They stay flat because interest expense always rises to offset any gain in operating profit. D. They cannot be determined without first knowing the firm's dividend policy. Don't overthink it. Which one feels right? The correct answer is B. They rise faster than the underlying business grew because a fixed interest cost lets the extra profit flow to a fixed share count. B is correct because interest expense is fixed, it does not grow when operating profit grows. The extra profit flows through to a fixed number of shares, lifting EPS and return on equity faster than the underlying business expanded. That is the rocket booster effect. A is wrong because the fixed interest charge does not grow with profit, it stays flat. It cannot grow faster than profit during an expansion. C is wrong because a fixed interest charge does not scale up to offset rising profit. The widening gap between rising profit and flat interest is precisely what boosts EPS. D is wrong because the direction of the effect on EPS and return on equity follows directly from the fixed interest charge and does not require knowing dividend policy. During a boom, a leveraged company's per share results can outrun its own business growth. That gap between how fast the business grows and how fast owners' returns grow is the rocket booster effect of debt. The engine is simple. Operating profit grows with the boom, but interest on fixed rate debt stays frozen. Every extra dollar passes that unchanged interest line and lands in a shareholder pool spread over fewer shares. A slimmer equity base also means the same profit produces a higher return on equity, and deductible interest adds a smaller, quieter boost on top. Picture two identical firms with the same operating profit. The levered firm pays fixed interest, shields some tax, and divides the rest over a smaller share count, producing standout earnings per share. The all-equity firm pays no interest but spreads its profit over a much larger ownership base, producing solid but unremarkable numbers. But this outperformance isn't free. It appears only when operating profit is high and rising, and it borrows against the same fixed charge that will punish the firm if profit later falls. The disciplined way to see this upside is as a loan drawn from the future, collected happily in good years, but repayable with interest whenever the cycle turns. Question 8. A recession cuts a home builder's revenue and operating profit roughly in half, yet the interest payment on its debt does not change. Which outcome best describes the anchor side of leverage in this situation? Your options are A. The interest charge automatically shrinks, so shareholders are shielded from the downturn. B. The lower profit is now spread across more shares, which cushions the decline. C. Business risk disappears because the firm has stopped growing. D. The unchanged interest charge eats a much larger share of a smaller profit pool, and a severe enough decline can threaten the firm's ability to cover its obligations. Got a guess? Lock it in. The correct answer is D. The unchanged interest charge eats a much larger share of a smaller profit pool, and a severe enough decline can threaten the firm's ability to cover its obligations. D is correct because when profit falls but the fixed interest charge does not, that charge takes a far larger bite out of a much smaller profit pool. If the downturn is severe enough, the firm may struggle to cover its obligations at all. That is the anchor effect in action. A is wrong because the interest charge does not shrink when profit falls. Its refusal to fall is exactly what makes debt dangerous in a downturn. B is wrong because a debt-funded structure typically leaves fewer shares outstanding, not more, and the core problem is the fixed charge rather than the share count. The lower profit is not cushioned, the fixed charge magnifies the damage. C is wrong because business risk does not disappear in a downturn. The uncertainty in operating profit that defines business risk is, if anything, more visible when sales collapse. We've seen how debt can act like a rocket booster, lifting earnings in good times. But that same fixed interest bill becomes an anchor the moment business turns down. When a downturn compresses operating profit, that fixed interest charge suddenly represents a much bigger bite of a much smaller pie. Earnings that once comfortably covered interest can shrink far faster in percentage terms than the underlying business declined. The damage rarely stays confined to the income statement. Credit ratings get cut. Raising borrowing costs exactly when cash is tightest, lenders tighten covenants, and customers and suppliers sensing distress may take their business elsewhere. Picture operating profit shrinking in a downturn while the interest charge stays exactly the same size. That fixed slice eats a much larger share of a much smaller pie, and what's left for shareholders collapses far faster than sales did. Leverage doesn't create the downturn, it magnifies it at the worst possible moment. Nothing about the debt changed, only the direction of the business did, and that's what turns a booster into an anchor. Question 9. Why are capital intensive? Cyclical companies such as heavy equipment makers, airlines, and home builders the standard teaching example for the dangers of carrying heavy debt? Your options are: A. Their sales swing hard with the economy, so a fixed debt payment is easy to cover in a boom but hard to cover in a downturn. B. They have no fixed operating cost, so every bit of their risk comes from debt. C. They are legally required to carry more debt than firms in other industries. D. Their revenues are unusually stable, which makes the effect of debt easy to isolate. Which one is it? Pause the video if you need more time. The correct answer is A. Their sales swing hard with the economy, so a fixed debt payment is easy to cover in a boom but hard to cover in a downturn. A is correct because these firms own expensive assets and earn revenues that rise and fall hard with the broader economy. A fixed debt payment is comfortable when sales boom, but becomes difficult to cover when a downturn slashes revenue, which puts the dual nature of leverage on full display. B is wrong because capital-intensive firms carry large fixed operating costs, not none. Those fixed operating costs are a major source of their business risk even before any debt is added. C is wrong because no law requires these industries to carry more debt. They illustrate leverage because of their cyclicality, not because of any borrowing mandate. D is wrong because their revenues are highly cyclical rather than stable. It is precisely the instability of their sales that makes them the classic example. Textbooks love heavy equipment makers, airlines, and home builders when teaching the dangers of debt, and that choice is deliberate. These industries share two traits that make leverage's best and worst effects unusually visible. First, these firms are capital intensive, owning expensive factories, fleets, and machinery often funded with debt. Second, they are cyclical, meaning sales surge and collapse with the broader economy. Together, fixed obligations and swinging revenue create leverage's most dramatic display. Picture fixed interest payments as a flat, unmoving line while revenue swings wildly above and below it. In a boom, revenue soars over that flat line and earnings rocket. In a bust, revenue dives below it and earnings crater. The interest bill never changes, so it's the swinging revenue that leverage amplifies. Consider an airline that borrowed heavily to buy aircraft during a travel boom. While planes flew full, the fixed debt payments looked trivial next to fat profits. When recession emptied the cabins, revenue collapsed. But the debt payments stayed exactly the same, and the airline burned through cash. The lesson is that leverage and cyclicality are a combustible pairing. A stable business can safely carry more debt, but a cyclical one courts real danger with the same load, because its profits can vanish overnight. Question 10. An instructor warns students not to label debt as simply good or bad, but instead to treat it as a magnifier. What does that framing mean in practice for a levered firm? Your options are: A. Debt always improves shareholder returns as long as interest rates stay low. B. Debt has no real effect on shareholder returns in either direction. C. Debt amplifies whatever direction the business is already heading, helping in an expansion and hurting in a contraction. D. Debt reduces the volatility of earnings per share compared with an all-equity firm. Take a second. Which answer would you pick? The correct answer is C. Debt amplifies whatever direction the business is already heading, helping in an expansion and hurting in a contraction. C is correct because leverage is a magnifier. The same fixed obligation that boosts returns when the business is expanding actively worsens results when it is contracting. Debt amplifies the direction the firm is already moving rather than being uniformly good or bad. A is wrong because debt does not always help. In a downturn, the same fixed charge deepens the decline, no matter how low the interest rate happens to be. B is wrong because debt has a large effect on shareholder returns. Ignoring that effect misses the entire point of leverage. D is wrong because debt increases the volatility of EPS rather than reducing it. A levered firm's EPS swings more than the EPS of an otherwise identical all-equity firm. Stop asking whether debt is good or bad. Debt has no fixed moral sign. It's a magnifier that amplifies whatever the business is already doing. The mechanism is the fixed interest charge. Because interest doesn't move with profit, it acts like a lever arm. The larger the fixed charge relative to profit, the longer the lever, and the bigger the swing in earnings per share for the same swing in operating profit. In an expansion, the firm with more debt pulls ahead, earnings per share rising faster than a conservative rival's. In a contraction, that same firm falls further behind. And all-equity firm's earnings move in lockstep with operating profit, while a levered firm's earnings swing wider in both directions. Picture a lever arm. Operating profit pushes on one end, fixed interest charges form the fulcrum, and earnings per share swing out the other end. The longer that arm, the bigger the amplification. The right stance is neither enthusiasm nor fear, but respect for what leverage does. It trades a smoother ride for a steeper one. So the real question is never yes or no on debt, but how stable the firm's operating profit really is. Question 11. A student needs the standard formula for a firm's debt ratio, the most common measure of how much of its financing comes from creditors rather than owners. Which expression is correct? Your options are: A. Total equity divided by total debt. B. Total debt divided by total capital, where total capital is total debt plus total equity. C. Total debt divided by annual net income. D. Total assets divided by total debt. Before I reveal it, which one do you think is right? The correct answer is B. total debt divided by total capital, where total capital is total debt plus total equity. B is correct because the debt ratio is total debt divided by total capital, and total capital is total debt plus total equity. It states what share of a firm's financing comes from creditors rather than owners. A is wrong because this inverts and mismatches the terms. Dividing equity by debt is a debt-to-equity comparison turned upside down, not the debt ratio. C is wrong because net income is a flow from the income statement, not a stock of financing on the balance sheet. The debt ratio compares debt to total capital, not to earnings. D is wrong because dividing total assets by total debt does not produce the share of financing supplied by creditors. The debt ratio puts debt over total capital, not assets over debt. Once we accept that a firm's financing mix matters, the next question is mechanical. How do we actually measure it? The answer is the debt ratio, a simple fraction with a very specific denominator. The debt ratio is total debt divided by total capital, where total capital is debt plus equity combined. A firm with 400 million in debt and 600 million in equity has 1 billion in total capital, giving a debt ratio of 40%. Total capital is the whole pool of financing, both borrowed and owned. So the debt ratio always measures debt against that entire pool, never against just one piece of it. A close cousin is the debt-to-equity ratio, which divides debt by equity instead of by total capital. The same firm has a debt ratio of 40%, but a debt-to-equity ratio of about 67%. So the real skill is converting fluidly between the two, rather than memorizing just one. The debt ratio is a neutral measuring tool, not a verdict of good or bad. The one guardrail to remember, a share of financing must be measured against the whole, and the whole is always total capital, debt plus equity together. Question 12. An accountant pulls the debt and equity figures for a capital structure calculation straight from the most recent balance sheet, using the historical accounting values recorded there. Which type of capital structure weights is being used? Your options are A. Market value weights, B. Target weights, C. Contribution weights, D. Book value weights. What's your answer? Commit to one before I continue. The correct answer is D. Book value weights. D is correct because book value weights or capital structure percentages calculated from the balance sheet, using the historical accounting values of debt and equity. Pulling the figures straight from the statements is the definition of using book weights. A is wrong because market value weights use the current market value of debt and the current market capitalization of equity, not the historical balance sheet figures. B is wrong because target weights are the forward-looking mix management intends to move toward, not the values recorded on the current balance sheet. C is wrong because contribution weights are not a capital structure measure at all. Contribution margin belongs to operating leverage and break-even analysis. Every capital structure calculation starts with numbers for debt and equity, and the easiest source is the company's own balance sheet. Weights built from those figures are called book value weights, using historical accounting values recorded over the firm's life. Book debt sits close to the face amount actually borrowed, since debt isn't marked up or down for market swings. Book equity stacks together the par value of common stock, additional paid-in capital, and retained earnings accumulated over time. Book figures only change through recorded accounting events, so they're stable, traceable, and easy to audit. That reliability is exactly why lenders lean on book values and loan covenants, where a number immune to stock market swings matters most. Picture a software firm that raised modest capital a decade ago and grew into a market favorite. Its balance sheet might show only a few $100 million in book equity, even as investors value that same equity in the billions. Book weights capture what was contributed and retained historically, not the firm's true current worth. When a scenario points to balance sheet figures, book weights are in play, and the sharp reader asks whether the market would tell a very different story. Question 13. A finance instructor says that one way of measuring capital structure is best practice because it reflects what investors believe the firm's securities are worth today, rather than what was raised or retained years ago. Which method is being described and why is it preferred? Your options are: A. Market value weights, because they reflect current investor expectations about the firm's future prospects. B. Book value weights, because they are drawn from audited historical statements. C. Target weights, because they never change once management sets them. D. Book value weights, because they always match the market value of equity. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is A. Market value weights, because they reflect current investor expectations about the firm's future prospects. A is correct because market value weights are preferred, because they reflect what investors today actually believe the firm's securities are worth based on its future prospects, not historical cost. Cost of capital work relies on market weights for exactly this reason. B is wrong because audited historical statements yield book weights, which describe the past. Being a reliable record of history does not make them the best gauge of current economic leverage. C is wrong because target weights are a planning tool, not the preferred current measurement. And the claim that they never change is wrong, since management can revise a target. D is wrong because book equity rarely matches market equity. For a firm whose stock trades well above book, the two diverge sharply, which is exactly why book weights can mislead. Market value weights answer the question that actually matters for financing decisions. What would it cost right now to buy out every investor in the firm? For equity, market value is the current share price times shares outstanding. For debt is what the securities would fetch today, though book often stands in since it's usually close. Book value, by contrast, only reflects what was contributed and retained in the past. A market price embeds everything investors currently believe about a firm's growth, risk, and competitive position, distilled into one number. A book value just records historical transactions, so for forward-looking decisions, market value is simply more useful. Take a mature manufacturer whose stock has climbed for years, measured at book. It looks heavily leveraged, measured at markets, with equity valued at what investors actually pay. It looks conservatively financed. Book values describe what was. Market values describe what is. When cost of capital and capital structure decisions are on the table, market weights keep the analysis honest. Question 14. A firm reports $500 million of debt and $500 million of book equity. So its book value debt ratio is 50%. Its stock trades well above book value, giving it a market equity value of $2 billion and its debt trades close to book. What is its market value debt ratio closest? Your options are A. 50%, B. 40%, C. 20%, D. 25%. Which would you go with? Lock it in before the reveal. The correct answer is C. 20%. C is correct because the market value debt ratio is total debt divided by total market capital. $500 million divided by the sum of $500 million debt and $2 billion market equity, which is $500 million over $2.5 billion, or about 20%. The gap from the 50% book ratio shows how far book and market weights can diverge. A is wrong because 50% is the book value ratio computed with book equity of $500 million. It ignores that the market values the equity at $2 billion. B is wrong because 40% does not follow from these figures. It would require a much smaller equity value than the $2 billion market capitalization stated. D is wrong because 25% comes from dividing debt by market equity alone, $500 million over $2 billion. Instead of by total capital, the denominator must be total debt plus total equity. How can one company be 50% debt financed according to its accountant, and only 20% debt financed according to a market analyst? Both can be completely right, and the reason reveals something essential about how leverage is actually measured. Start with the balance sheet. 500 million in debt and 500 million in book equity gives a 50% book debt ratio. But if the stock is appreciated to a market value of 2 billion, total market capital becomes 2.5 billion, and that same debt now represents just 20%. The mechanism is simple. Book equity is anchored to historical contributed capital and retained earnings, so it barely moves. Market equity floats on the stock price, swelling whenever investors grow optimistic about the firm's future. Picture the same firm's capital structure measured two ways. The book view stacks debt against historical equity, while the market view stacks the same debt against a far larger price-driven equity value. A banker citing covenant terms and an analyst citing current valuation aren't disagreeing. They're using different, internally consistent bases. Always ask whether a debt ratio rests on book or market values, because the market figure is the one that truly governs financing and valuation. Question 15. An exam problem gives both the book value figures and the market value figures for a company's debt and equity, then asks for the firm's capital structure without saying which basis to use. Which figures should be used and why? Your options are A. Book values, because they are the more conservative choice. B. Market values, because market value is the best practice default for capital structure and cost of capital work. C. The simple average of the book and market figures. D. Whichever set produces the lower debt ratio. Don't overthink it. Which one feels right? The correct answer is B. Market values, because market value is the best practice default for capital structure and cost of capital work. B is correct because when a problem supplies both and does not specify, best practice is to use market values. This is a heavily tested convention. The exam wants to see that market value is the default for capital structure and cost of capital decisions. A is wrong because there is no rule that the conservative or lower figure wins. The default is market value because it reflects current worth, not because it is cautious. C is wrong because averaging the book and market figures is not a recognized method. The two answer different questions, and market value is the one used for decisions. D is wrong because choosing the basis that yields the lower ratio has no analytical footing. The choice is driven by best practice, which points to market value regardless of which ratio is lower. When a problem gives you both book and market figures and doesn't say which to use for capital structure, that silence isn't an oversight, it's the test. The expected default is always market value. Market weights capture what investors believe the firm is worth right now, which is exactly what matters for forward-looking decisions like raising capital or estimating a cost of capital. Book weights just describe historical cost, and history can drift far from present reality. A few instincts lead you astray here. Picking the book figure because it seems more conservative or official, averaging the two numbers as if the truth lies in between, and choosing whichever basis gives the smaller debt ratio or substitute comfort for the actual rule, which is relevance, not caution or convenience. Picture a problem listing book debt and equity in one column, market debt and equity in the next, then simply asking for the debt ratio. The disciplined move is to compute from the market column and treat the book column only as context. Absent explicit instruction, market value governs, not because it's bigger or smaller, but because it's what financing and cost of capital decisions actually run on. Defaulting to market value is the reading that best practice rewards. Question 16. A company has 50 million shares of common stock outstanding, and the stock currently trades at $30 per share. What is the market value of the firm's equity? Your options are A. 50 million, B. 80 million dime, C. 600 million dime, D. 500 million. Got a guess? Lock it in. The correct answer is D. $500 million. D is correct because the market value of equity is the current share price multiplied by the number of shares outstanding. $30 times 50 million shares equals $1,500 million. That is what it would cost to buy out every shareholder at today's price. A is wrong because 50 million is the share count, not a dollar value. It must be multiplied by the price per share to reach the market value of equity. B is wrong because 80 million adds the price and the share count instead of multiplying them, which does not produce a market value. C is wrong because 600 million would be the figure if the stock traded near its roughly $12 book value per share, not at its actual $30 market price. The market value of equity answers a simple question. What would it cost to buy every share of a company right now? It's the foundation for how we weight equity in capital structure work. Consider a firm with 50 million shares trading at $30 each. Multiply price by share count and you get $1.5 billion, the true market value of equity. Adding price and share count together is meaningless since they measure different things. Using the share count alone confuses a quantity of shares for a quantity of dollars. Value is always price times quantity. The same firm might carry book equity of $600 million, built from historical accounting entries, but the market prices that same equity at $1.5 billion because price reflects expectations, not history. Whenever a cost of capital or capital structure calculation calls for equity weight, use the market value, since that's what investors are actually pricing today. The book figure would understate equity and distort every number that follows. Question 17. A firm carries $400 million of debt, which trades close to book value, along with 50 million shares of stock priced at $30 each. What is its market value debt ratio closest? Your options are A. 42%, B. 26.7%, C. 21.1%, D. 13.3%. Which one is it? Pause the video if you need more time. The correct answer is C. 21.1%. C is correct because market equity is $30 times 50 million shares, or $500 million. Total market capital is 400 million debt plus $500 million equity, or $900 million. The debt ratio is $400 million divided by 1,900 million, about 21%. I is wrong because 40% divides debt by a total built on book equity near $600 million rather than the $1,500 million market equity. That is the book ratio, not the market ratio. B is wrong because 26.7% does not match these inputs. It would require a total market capital near $500 million, which is less than the equity value alone. D is wrong because 13.3% understates the ratio as if equity were about $3 billion. The stated market equity is $1,500 million, not $3 billion. Computing a market value debt ratio is a 3-step routine, and the real discipline is getting the denominator right, not the arithmetic. First, value the equity at market. Second, add the value of the debt to reach total market capital. Third, divide the debt by that total, and skipping the second step is exactly where the common mistake lives. Picture a firm with 400 million in debt and 50 million shares priced at $30. giving $1.5 billion in market equity, for a total market capital of $1.9 billion and a market debt ratio a little over 21%. The most frequent error divides debt by equity alone instead of total capital, which is a debt to equity comparison, not the debt ratio. A second error quietly swaps in book equity, mislabeling a book ratio of 40% as if it were the market figure. The debt never changed, only the yardstick on equity did, in nearly tripling it and roughly halving the ratio. Whenever a prompt gives a share price, share count, and debt figure, build market equity, add debt, and divide to get the ratio that financing decisions actually rely on. Question 18. After financing a large acquisition entirely with debt, a firm sits well above its long-run comfort zone and announces a plan to pay that debt down over the next several years to reach the mix it really wants. That intended future mix is best described as the firm's what? Your options are A. Target weights, B. Book value weights, C. Market value weights, D. Contribution margin. Take a second. Which answer would you pick? The correct answer is A. Target weights. A is correct because target weights are the capital structure percentages management intends to move toward over time, which may differ from both current book and current market weights. A stated plan to deliver toward a preferred mix is a forward-looking target. B is wrong because book value weights measure where the firm stands now on the balance sheet, not the future mix it plans to reach. C is wrong because market value weights measure the firm's current mix at today's prices, not the forward-looking policy goal it is steering toward. D is wrong because contribution margin is price minus variable cost per unit, a cost structure concept unrelated to a target financing mix. Book and market weights both describe where a firm stands right now or where its past financing left it. Target weights describe something entirely different, where management intends to go. That difference in tense is the whole concept. Book and market weights change constantly, one through accounting events, the other through stock price movement. Target weights change only when management deliberately revisits its policy, since they express intention rather than a current reading. Picture a firm pushed to 50% debt by a large acquisition, but publicly committed to a long-run target near one-third debt. Its market weights today plainly show the elevated leverage, while its target is a pledge to deliver over coming years. A subtlety that trips people up is assuming the target must fall between the current book and market figures, or must eventually match one of them. It need not. The target is chosen by weighing debt's cost advantage against its risks, independent of where the firm happens to sit today. The distinction to secure is that target weights are prescriptive, while book and market weights are descriptive. Whenever a scenario mentions a mix management aims to maintain or a long-run policy it is steering toward, that's the target, cleanly separate from where the firm actually sits right now. Question 19. A fast-growing firm stock trades far above its book value per share. Which statement best explains why the market value of its equity so sharply exceeds the book value of its equity? Your options are A. Book value reflects investor expectations about future cash flows, so it should be the higher figure. B. The market value is set once a year by regulators and rarely tracks real worth. C. Accounting rules require equity to be marked up to match the share price each quarter. D. Market value reflects investor expectations about all of the firm's future cash flows, while book value reflects historical contributed capital and accumulated retained earnings. Before I reveal it, which one do you think is right? The correct answer is D. Market value reflects investor expectations about all of the firm's future cash flows, while book value reflects historical contributed capital, and accumulated retained earnings. D is correct because market value of equity captures what investors expect from all of the firm's future cash flows, while book value records historical contributed capital and retained earnings built up slowly over time. For a fast-growing firm, the future prospects dwarf the accumulated history, so market value runs far above book. A is wrong because this reverses the roles. Book value reflects historical cost, not forward-looking expectations, which is why it tends to be the lower figure. B is wrong because share prices are set continuously by investors in the market, not annually by regulators, and they track investor expectations closely. C is wrong because accounting does not mark equity up to the share price. Book equity moves only through accounting events such as earnings, dividends, and share transactions. Why do a firm's book equity and market equity so often differ, sometimes by a huge margin? The answer isn't an accounting error. It's that the two numbers are built to measure completely different things. Book equity is a record of contribution and retention. It sums the capital shareholders originally paid and plus earnings the firm has kept, so it tallies what has already gone into the company. Market equity works differently. The share price reflects investors' collective bet on all the cash the firm will generate in the future, discounted for risk. It prices what the firm is expected to become, not what it has already banked. For a young, fast-growing firm, the value of future prospects dwarfs its modest historical capital, so market equity towers over book equity. For a stagnant firm, the two can sit close, or market value can even fall below book. That's why market weights, not book weights, are used for decisions about the future. The gap between the two isn't a flaw. It's information about how the market views what's ahead. Question 20. A company's own filing shows a 45% book value debt ratio, while an analyst report describes the same firm as roughly 22% debt financed. Assuming both are computed correctly, what most likely explains the gap? Your options are A. One of the two figures must simply be an error. B. The analyst is using the market value of equity, likely well above book, in the denominator, which lowers the debt ratio. C. The analyst is using the book value of equity while the filing is using market value. D. The two figures cannot both be correct under any convention. What's your answer? Commit to one before I continue. The correct answer is B. The analyst is using the market value of equity, likely well above book, in the denominator, which lowers the debt ratio. B is correct because both figures can be right under their own convention. The analyst is almost certainly using the market value of equity, which after years of retained earnings and stock appreciation sits well above book, enlarging the denominator and pulling the market debt ratio below the book ratio. A is wrong because neither figure needs to be an error. They answer different questions, one on a book basis and one on a market basis, and both can be correct at once. C is wrong because this reverses the likely basis. A lower analyst ratio comes from a larger market equity denominator, so the analyst is using market equity, not book, while the filing uses book. D is wrong because both can be simultaneously correct. Book and market debt ratios routinely differ for a firm whose stock trades above book value. A company's filing says it's 45% debt financed, but an analyst's report says 22%. Both can be right at once. The disagreement is about the denominator, not the facts. The filing almost certainly relies on book values from the balance sheet, while the analyst uses the market value of that same equity. When years of retained earnings and rising expectations push the stock above book value, the market denominator grows and the ratio drops. The same debt sits on top of two different equity values underneath. A larger market equity in the denominator is what produces the smaller 22% ratio. It's tempting to think one number is simply wrong, or that both can't be valid, or that the assignment is reversed. None of that holds. Both figures are correct under their own conventions, and the market basis is always the one producing the lower ratio when a stock trades above book. A skilled reader doesn't discard either number. They recognize the filing as a book measure and the analyst's figure as a market measure. Then rely on the market figure for decisions about financing capacity and cost of capital. Question 21. A firm issues new bonds and uses all of the proceeds to repurchase its own common stock. This is a clear example of what kind of capital structure change. Your options are A deliberate capital structure action taken on purpose by management. B. A passive market-driven shift caused only by the stock price. C. A change in business risk with no effect on financing. D. An accounting reclassification that leaves both book and market weights unchanged. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is A. A deliberate capital structure action taken on purpose by management. A is correct because issuing debt to fund a buyback is a conscious financing decision that intentionally shifts the debt-equity mix. Management chose to add debt and shrink equity, which is the definition of a deliberate capital structure action. B is wrong because a passive shift involves no new securities, only a moving stock price. Here the firm actively issued bonds and retired shares, so the change is deliberate, not passive. C is wrong because this move changes financing directly. It raises financial leverage rather than leaving financing untouched, and it does not alter the underlying business risk. D is wrong because issuing debt and buying back stock are real transactions that move both book and market weights. It is not a mere reclassification. When a firm issues bonds and uses the cash to buy back shares, it has deliberately reshaped its capital structure. This is a conscious financing decision by management, not an accident. Someone chose to add debt and retire equity, and could have chosen otherwise. Deliberate actions come in a handful of recognizable forms. Issuing bonds raises debt, repaying debt lowers it, selling new shares raises equity and dilutes owners, and repurchasing shares lowers equity and concentrates ownership. A debt-funded buyback does two at once, pushing debt up and equity down together. What separates deliberate action from mere market drift is that real dollars change hands and real securities are issued or retired. That dual footprint, both the book and market versions of the capital structure moving together, is the reliable sign that the firm actually transacted. Deliberate actions are the lever a firm uses to steer toward its target. A company below its target debt weight can issue bonds to climb toward it, while one above target can issue equity or repay debt to descend. Deliberate action is the steering, and the target is the destination. Lock in this distinction. A deliberate action is defined by an actual financing transaction undertaken on purpose, never by a swing in stock price. Whenever a scenario describes issuing, retiring, or borrowing to fund a move, that's deliberate action. Sharply different from passive drift, which shifts the mix with no transaction at all. Question 22. Over the course of a year, a company's stock price rises sharply on strong earnings news, while it issues and retires no securities at all. Its market value debt ratio falls. This change is best classified as what? Your options are A. A deliberate capital structure action. B. A change in the firm's target weights. C. A passive market-driven shift in capital structure. D. A change in the firm's book value debt ratio. Which would you go with? Lock it in before the reveal. The correct answer is C. A passive market-driven shift in capital structure. C is correct because a passive shift is a change in market value weights caused purely by stock price movement. with no securities issued or retired. A rising price lifts the market value of equity, so the market debt ratio falls on its own. That is passive drift. A is wrong because no financing decision was made. Because management issued and retired nothing, the change is passive rather than a deliberate action. B is wrong because the target is management's policy goal, which does not change just because the stock price moved. Nothing here states a new target. D is wrong because book value weights do not move with the stock price. Only the market value debt ratio shifted here. The book ratio is untouched. Capital structure can drift even when management does absolutely nothing. This quiet, unbidden change is called a passive shift, a move in market value capital structure caused purely by stock price movement, with no securities issued and none retired. The mechanism comes down to which side of the ledger actually moves. Debt's market value stays tethered to contracts and interest rates, holding roughly steady, while equity's value swings freely with the stock price on any given day. The direction follows straight from the arithmetic. When the stock price rises, equity swells and debt becomes a smaller slice of a bigger pie, so the market debt ratio falls. When the stock price falls, equity shrinks and debt becomes a larger slice of a smaller pie, so the ratio rises. Picture a manufacturer whose shares climb steadily through a strong year. It issues no stock and repays no debt. Yet by December, its market debt ratio is noticeably lower, simply because its equity is worth more. The lesson to carry forward: a change in leverage is not automatically a decision. When a scenario shows the stock price moving with no securities issued or retired, that change is passive. Resist crediting management for something the market did on its own. Question 23. A firm's total debt outstanding is unchanged for the year, but its share price climbs steadily on good news. Holding everything else constant, what happens to its market value debt ratio and why? Your options are: A. It rises because a higher stock price makes the firm look riskier to lenders. B. It falls because the market value of equity grows while debt holds steady, so debt is a smaller slice of a larger total. C. It stays exactly the same because no new shares were issued. D. It cannot be determined without knowing the firm's tax rate. Don't overthink it, which one feels right? The correct answer is B. It falls because the market value of equity grows while debt holds steady, so debt is a smaller slice of a larger total. B is correct because when the share price rises with debt unchanged, the market value of equity grows while debt stays flat. Debt becomes a smaller share of a larger total market capital, so the market value debt ratio falls automatically, with no financing action required. A is wrong because a rising stock price signals strength and lowers, not raises, the market debt ratio. Lenders do not treat a higher share price as a reason to view the firm as more leveraged. C is wrong because the market debt ratio depends on the market value of equity, which rises with the price even if the share count is unchanged. It does not stay the same. D is wrong because the direction of the change follows purely from the larger equity value set against unchanged debt. The tax rate is not needed to see that the ratio falls. A company can become less leveraged without paying off a single dollar of debt, simply because its stock price rose. That sounds strange at first, but on a market value basis, the arithmetic makes it unavoidable. The ratio puts debt over debt plus the market value of equity. If the share price climbs, equity grows while debt holds steady. So the denominator expands while the numerator stays fixed, and the fraction must shrink. Leverage is a relative quantity, a comparison of debt against everything else financing the firm. When the equity slice of the pie grows, the same debt slice automatically looks smaller relative to the whole. Picture a distributor whose stock rises by half over a year, while its debt stays exactly the same. Its equity value has grown substantially, its debt has not, so its market debt ratio falls, purely from share price appreciation. A rise in share price and a fall in market debt ratio travel together, mechanically and without any action from management. A bigger equity denominator simply makes the same debt a smaller share of the total. Question 24. A firm has 400 million of debt and 50 million shares. Its stock falls from $30 to $20 during a downturn with no new financing. Its market value debt ratio was about 21% before the drop. What is it after the drop closest? Your options are A. 21%, B. 40.0%, C. 6%, D. 28.6%. Got a guess? Lock it in. The correct answer is D. 28.6%. D is correct because new market equity is $20 times 50 million shares, or $1,000 million. Total market capital is $400 million debt plus $1,000 million equity, or $400 million. The debt ratio is $400 million divided by $400 million, about 29%, up from 21% purely because equity got cheaper. Is wrong because 21% was the ratio before the price fell, when equity was worth $500 million. After the drop to 20s, equity is worth less, so the ratio must be higher. B is wrong because 40% is the book value ratio, which does not move with the stock price at all. The question asks for the market ratio after the price change. C is wrong because 16.7% points the wrong direction below the starting ratio. A falling price raises the market debt ratio rather than lowering it. A falling stock price does the opposite of a rising one. It makes a firm look more leveraged in the market's eyes. Even though management does nothing, let's walk through the numbers before and after a slump. Start with the healthy baseline. The firm carries $400 million in debt and 50 million shares trading at $30, giving market equity of $1.5 billion, total capital of $1.9 billion, and a market debt ratio just over 21%. Now a recession cuts the share price to $20 with no new financing. Market equity shrinks to $1 billion. Total capital falls to $1.4 billion, and the market debt ratio climbs to roughly 29%. Even though the firm did nothing at all. The debt term held steady at $400 million, but equity shrank as the price fell, so the denominator contracted while the numerator stayed put. The firm became more leveraged purely because its equity got cheaper, not because it borrowed another dollar. Notice the book debt ratio never moved, since book equity ignores share price, while the market ratio jumped about 8 percentage points. That gap is exactly why market weights are watched more closely than book weights. Question 25. Through a full year in which a company's stock price more than doubled, its book value debt ratio stayed at exactly 40%, even though its market value debt ratio dropped sharply. What best explains why the book ratio did not move? Your options are: A. The book value of equity is recalculated each day to reflect the current stock price. B. The firm must have quietly issued new debt to hold the book ratio steady. C. Book equity changes only through accounting events such as net income, dividends, and share transactions, not through daily price moves. D. Book value debt ratios are legally required to equal market value debt ratios. Which one is it? Pause the video if you need more time. The correct answer is C. Book equity changes only through accounting events such as net income, dividends, and share transactions, not through daily price moves. C is correct because book equity moves only through accounting events, net income, dividends, and share issuances or buybacks, never through the day-to-day stock price. So a stock rally alone leaves the book ratio flat even as the market ratio shifts a great deal. A is wrong because book equity is not marked to the daily share price. That is precisely why the book ratio held still while the market ratio moved. B is wrong because no new debt is needed to keep the book ratio steady. It stayed flat simply because book equity does not respond to the stock price. D is wrong because there is no such legal requirement. Book and market debt ratios routinely diverge, which is the entire point of the example. A company's stock price can more than double in a year, yet its book debt ratio stays exactly the same while its market debt ratio falls sharply. That seems strange until you realize what book equity actually responds to. Book equity changes only through recorded accounting transactions, retained net income, dividends paid, and share issuance or repurchase. Daily swings in the stock price are not among them. So unless the firm actually transacts, none of that market movement touches book equity. On the books, debt holds near its face amount, and equity holds at its historical value, so their ratio holds too. The market ratio uses the same debt, but its equity term gets revalued by the exchange every second it's open, telling a completely different story. This steadiness is a virtue for something like a loan covenant that needs a figure immune to market swings. But for gauging a firm's true current leverage, that same steadiness becomes a liability, since the book ratio can broadcast calm while the market ratio records a real shift. Book equity answers only to accounting events, never to the stock price itself. So when a book ratio holds steady despite a huge move in shares, there's no hidden trick. Just a figure that was never built to hear the market. Question 26. An instructor defines a type of risk as the uncertainty in a firm's future operating income, or EBIT, assuming the firm used no debt at all. Which type of risk is this? Your options are A. Business risk, B. Financial risk, C. Interest rate risk, D. Default risk. Take a second. Which answer would you pick? The correct answer is A. Business risk. A is correct because business risk is the uncertainty in a firm's projected operating income or return on invested capital, assuming it used no debt at all. It is the risk of the underlying enterprise itself, independent of how the firm is financed. B is wrong because financial risk is the extra risk debt places on shareholders. By definition, it is zero for an all-equity firm, so it cannot be the risk that exists with no debt. C is wrong because interest rate risk concerns how changing rates affect bond prices or borrowing costs, not the uncertainty in operating income for an unlevered firm. D is wrong because default risk is the chance a borrower fails to pay its debts, which requires debt to exist. The described risk assumes no debt at all. Long before a company ever borrows $1, its business already carries risk. That inherent uncertainty in operating results has a name: business risk. Business risk is the uncertainty in a firm's projected operating income, its earnings before interest and taxes, or its return on invested capital, all measured as if the firm used no debt at all. That phrase, no debt at all, isolates the risk of the enterprise itself from any risk added by financing. Business risk comes entirely from the operating side of the firm: demand patterns, competitive dynamics, and cost structure, including how exposed the industry is to the economic cycle. It has nothing to do with how the firm is financed. Picture a construction equipment maker whose sales swing with building activity. Even with zero debt, its operating income would still swing hard from boom to bust, because that cyclicality is baked into the business itself. Two firms in the same industry face identical business risk, whether one is loaded with debt and the other has none, because business risk is operating uncertainty measured as if the firm were unlevered. Question 27. An analyst wants a statistical measure of a firm's business risk. Which quantity best captures it? Your options are A. The firm's average return on invested capital over the past 5 years. B. The firm's current debt ratio. C. The firm's dividend payout ratio. D. The standard deviation of the firm's return on invested capital, or EBIT, measured over time. Before I reveal it, which one do you think is right? The correct answer is D. The standard deviation of the firm's return on invested capital, or EBIT, measured over time. D is correct because business risk is measured by the standard deviation of return on invested capital, or equivalently EBIT, over time. The more those operating results bounce around from year to year, the higher the business risk. A is wrong because the average return level says nothing about risk. Two firms can share the same average return while one is far more volatile, so the average alone cannot measure risk. B is wrong because the debt ratio reflects financing choices and drives financial risk, not business risk, which concerns operating results assuming no debt. C is wrong because the dividend payout ratio is a payout policy decision. It does not measure the volatility of the firm's operating performance. Defining business risk as operating uncertainty is only half the job. The other half is measuring it, and finance has a precise tool for that job. Business risk is quantified by the standard deviation of return on invested capital or operating income, computed across years. A firm's average return only tells you how profitable it has been, not how risky it is. What matters is how much that return bounces from year to year. Picture two firms with the exact same average return on invested capital over several years. One firm's line stays nearly flat, clustering tightly around that average, while the other's line lurches wildly between banner years and losing years. The subtlety that catches people is this: a high average return does not mean a firm is safe. The wider the scatter, the larger the standard deviation, and the greater the business risk, even when the averages match exactly. So whenever a question asks how to quantify business risk, or contrast two firms with equal averages but different volatility, the answer is the standard deviation of return on invested capital or operating income. Variability is what carries the meaning. Question 28. Two firms each posted an average return on invested capital of 10% over the past 5 years. The first firm's yearly return stayed within a narrow band near 10%, while the second firm's returns swung from near 0 to 20%. Which firm carries more business risk and why? Your options are: A, the first firm, because a steady 10% return is a sign of hidden weakness. B, the second firm, because its returns have a much larger dispersion, even though the average is identical. C, neither, because business risk depends only on the average return, which is the same for both. D, the first firm, because narrow ranges always signal more risk than wide ones. What's your answer? Commit to one before I continue. The correct answer is B, the second firm, because its returns have a much larger dispersion, even though the average is identical. B is correct because business risk is about the dispersion of returns, measured by standard deviation, not the average level. The second firm's returns swing far more widely around the same 10% average, so it carries materially more business risk. A is wrong because a steady return is a sign of low risk, not hidden weakness. Stability of operating results is exactly what low business risk looks like. C is wrong because business risk depends on the variability of returns, not their average. Identical averages do not make the two firms equally risky. D is wrong because this states the relationship backward. Wider ranges, not narrow ones, signal more business risk, so the second firm is the riskier one. Two firms can post the exact same average return over 5 years and still carry wildly different levels of business risk. The trick is that risk isn't about the average at all. It's about how much the numbers bounce around it. Picture a steady firm making a staple product with returns of 10, 11, 9, 10, and 10%. Now picture a volatile firm tied to construction and mining cycles with returns of 25, 15, 0 and 10%. Both average exactly 10%. Lay these side by side and the standard deviation tells the real story. The steady firms is well under 1%, while the volatile firms lands around 7%, more than 10 times larger, even though both share the identical 10% mean. A firm that might earn 20% or might earn 0 in any given year is far less certain than one that reliably earns close to 10. Investors and lenders care about that uncertainty, because a wider scatter means less confidence in what comes next. When two firms share the same average return, the disciplined reading looks past that shared number and focuses on the spread of returns to judge which business is truly riskier. Question 29. Which of the following is a genuine driver of a firm's business risk? Your options are A. Wide swings in unit sales demand that the firm cannot easily predict. B. The proportion of debt the firm carries in its capital structure. C. The firm's choice of dividend payout ratio. D. The maturity structure of the firm's outstanding bonds. Pick one, trust your gut, here's your chance to test yourself. The correct answer is A. Wide swings in unit sales demand that the firm cannot easily predict. A is correct because demand variability is a core driver of business risk. When unit sales are hard to predict or highly cyclical, operating income becomes more uncertain, which is exactly what business risk captures. B is wrong because the amount of debt a firm carries is a financing decision that drives financial risk, not business risk. Business risk assumes the firm used no debt at all. C is wrong because the dividend payout ratio is a payout policy choice. It does not change the uncertainty in the firm's underlying operating income. D is wrong because the maturity structure of bonds is a feature of the firm's debt, so it relates to financing rather than to the operating uncertainty that defines business risk. Business risk isn't caused by one thing. It's the combined product of several operating forces, all rooted in how a firm runs its business, not how it finances itself. Demand variability heads the list. Unpredictable sales, like construction equipment orders, create more risk than steady staples. Then come price and cost behavior, volatile sales prices, unpredictable input costs, and weak pricing power all squeeze operating income. Rounding it out are product development risk, foreign exposure, and operating leverage, which magnifies all the others. A construction equipment maker sees orders surge and collapse with the building cycle, sitting at the high end of demand variability. A maker of daily staples, bought steadily in good times and bad, sits at the low end. The more uncertain the volume, the higher the business risk. What ties this whole list together is what's missing. Not one driver mentions debt, interest, or capital structure, because business risk assumes an all-equity firm. A company's borrowing raises total risk through a separate channel called financial risk, never through the operating forces above. So when a question asks, what drives a firm's business risk, the answer is always an operating trait. Debt load is the classic trap, but it belongs to financial risk instead. Question 30. A firm currently has no debt and is deciding whether to issue bonds to fund a stock buyback. Which type of risk would rise as a direct result of that action, while the other stays unchanged? Your options are A. Business risk would rise while financial risk stays unchanged. B. Both business risk and financial risk would rise equally. C. Financial risk would rise while business risk stays unchanged. D. Neither type of risk would change since the operations are the same. Which would you go with? Lock it in before the reveal. The correct answer is C. Financial risk would rise while business risk stays unchanged. C is correct because adding debt to fund a buyback introduces fixed interest charges, which raises financial risk. The underlying operations, demand, costs, and pricing power are untouched, so business risk stays exactly where it was. A is wrong because this reverses the two. Issuing debt does not change the operating business, so business risk holds steady while financial risk rises. B is wrong because the two do not rise equally. Only financial risk responds to a financing decision. Business risk is unaffected by how the firm is financed. D is wrong because financial risk does change. Committing to fixed interest payments raises the risk borne by shareholders, even though operations are unchanged. Imagine an all-equity firm the day before it takes on its first loan. Every bit of risk its shareholders bear comes from the business itself, because there's no fixed financing charge anywhere yet. Financial risk is the extra risk placed on shareholders when the firm finances assets with debt or other fixed charge sources. It stacks on top of business risk rather than replacing it. So total shareholder risk is business risk plus this new financial risk. Debt doesn't change the underlying demand, costs, or pricing power of the business. But because fixed interest must be paid first, the same operating swings now concentrate onto a smaller pool of equity, hitting shareholders harder. That amplification is financial risk. The test is simple. Ask what a change would do to an all-equity version of the firm. A shift in demand or cost structure changes business risk, while issuing debt or preferred stock changes only financial risk, leaving operations untouched. So when a firm borrows to fund a buyback, operations stay identical and business risk holds steady, while financial risk rises because fixed interest now concentrates unchanged operating swings onto fewer owners. The trap is ever letting a financing decision reach into the operating side. Question 31. A manufacturer builds a highly automated plant, so most of its costs are fixed depreciation and salaried staff rather than per unit materials and hourly labor. The extent to which a firm uses fixed rather than variable operating costs in its cost structure is called what? Your options are A. Financial leverage, B. Operating leverage, C. The debt ratio, D. The contribution margin. Don't overthink it. Which one feels right? The correct answer is B. Operating leverage. B is correct because operating leverage is the extent to which a firm builds fixed operating costs rather than variable costs into its cost structure. A plant dominated by fixed depreciation and salaries has high operating leverage. A is wrong because financial leverage refers to the use of debt and other fixed charge financing, not to the fixed versus variable split of operating costs. C is wrong because the debt ratio measures the share of financing from creditors, a capital structure figure, not the cost structure concept described here. D is wrong because contribution margin is price minus variable cost per unit. It is an input to leverage math, not the name for a fixed cost heavy structure. Every company's cost structure leans somewhere between two extremes, and that lean creates a property called operating leverage, how much a firm relies on fixed costs versus variable costs. Fixed costs like rent, depreciation, and salaried management stay constant no matter how much a firm sells. Variable costs like raw materials and sales commissions rise and fall directly with output. This mix isn't just inherited, it's engineered. A firm can push toward fixed costs by automating production or push toward variable costs by outsourcing to a contractor who charges per unit. Picture a manufacturer choosing between an owned automated plant and a contract manufacturer. The owned plant's heavy fixed depreciation makes profits soar in a boom, but collapse in a bust, while the contractor's low fixed cost keeps profits smoother either way. The takeaway: operating leverage is simply the fixed versus variable tilt of a cost structure, and a heavier fixed tilt magnifies swings in operating profit, making it a core source of business risk. Question 32. A company sells a product for $50 per unit, with variable costs of $30 per unit and fixed operating costs of $400,000 per year. What is its operating break-even point in units? Your options are A. 8,000 units, B. 13,033 units, C. 40,000 units, D. 20,000 units. Got a guess? Lock it in. The correct answer is D. 20,000 units. D is correct because operating break-even in units equals fixed cost divided by the contribution margin per unit. The contribution margin is $50 minus $30 or $20. So break-even is $400,000 divided by $20, which is 20,000 units. A is wrong because 8,000 units results from dividing by the $50 price alone. The denominator must be price minus variable cost, not the full price. B is wrong because 13,333 units comes from dividing $400,000 by 30 clears. The variable cost, which is not the contribution margin. C is wrong because 40,000 units comes from dividing $400,000 by a 10 margin. The correct contribution margin here is $20 per unit, not $10. Every manager wants to know one thing before committing to a cost structure. How many units must we sell just to stop losing money? That volume, where operating income equals exactly 0, is the operating break-even point. The contribution margin per unit is selling price minus variable cost. If a product sells for $1,000 and costs $600 to make, each unit contributes $400 toward covering fixed costs. Put the pieces together. Fixed costs of $2 million divided by a $400 contribution margin gives a break-even point of 5,000 units. Sell the 5,000 first unit and the firm crosses into operating profit. The most common mistake is dividing by the wrong denominator. Using price alone overstates coverage, and using variable cost alone is meaningless. The denominator must always be price minus variable cost. Notice too that a high break-even point signals high operating leverage, since heavy fixed costs demand large sales volume before profit begins. Keep this rule: break-even equals fixed cost divided by contribution margin, and contribution margin is always price minus variable cost, never price alone. Question 33. The degree of operating leverage, or DOL, at a given sales level is defined as which ratio? Your options are A. The percentage change in sales divided by the percentage change in E by T. B. Fixed costs divided by variable costs. C. The percentage change in EBIT divided by the percentage change in sales. D. The percentage change in EPS divided by the percentage change in EBIT. Which one is it? Pause the video if you need more time. The correct answer is C. The percentage change in EBIT divided by the percentage change in sales. C is correct because the degree of operating leverage is the percentage change in EBIT produced by a given percentage change in sales at a specific sales level. It measures how strongly operating profit responds to a change in sales volume. A is wrong because this inverts the ratio. DOL puts the percentage change in EBIT on top and the percentage change in sales on the bottom, not the reverse. B is wrong because a raw ratio fixed to variable costs is not how DOL is defined. DOL is expressed as the sensitivity of EBIT to a change in sales. D is wrong because the percentage change in EPS over the percentage change in EBIT defines the degree of financial leverage, not operating leverage. Fixed costs magnify operating profit, but the degree of operating leverage turns that idea into a precise number. It tells us exactly how much operating profit moves for every 1% move in sales. The measure is a ratio, operating profits percentage change on top, sales percentage change on the bottom. A degree of 2 means a 1% sales move produces roughly a 2% profit swing. A degree of 3 makes that swing 3%. The larger the number, the more violently profit reacts and the more operating risk the firm carries. This measure is taken at a specific sales level, not fixed forever. Close to break even, fixed costs loom large against thin profit, so the degree of operating leverage is higher. Far above break even, it settles toward 1, since fixed costs become a smaller relative drag. It's easy to confuse this with its financial cousin. Degree of operating leverage links sales to operating profit through the cost structure, while degree of financial leverage links operating profit to earnings per share through financing. One lives on the operating side, the other on the financing side. Picture a firm with a degree of operating leverage near 2.5. A 10% jump in sales lifts operating profit roughly 25%, and a 10% drop cuts it by about the same. Whenever a scenario gives you both numbers, just multiply them together. Question 34. Summit Machine Works sells a component for $1,000 per unit with variable cost of $600 per unit and fixed operating costs of $2,000 close. At a sales level of 8,000 units, what is its degree of operating leverage closest? Your options are: I do sales. B, once en I zero-3-8. D, forever. Take a second. Which answer would you pick? The correct answer is A, 287. A is correct because contribution is 8,000 units times the $400 margin, or $200,000. EBIT is that contribution minus $2,000 of fixed costs, or way does $200,000. DOL equals contribution divided by EBIT, 3,200 out over 1,200,000, about 2,167. B is wrong because 1.6 does not match these figures. It would require a different mix of contribution and fixed costs than the ones given. C is wrong because 0.38 inverts the ratio dividing EBIT by contribution. Dowell puts contribution over EBIT and is at least 1 for a profitable firm carrying fixed costs. D is wrong because 4.0 would require EBIT of $800,000 against the $3,200,000 load contribution. Here EBIT is $200,000, so the ratio is about 2.67, not 4. Computing degree of operating leverage is a two-part exercise. Build the operating profit, then take the ratio of contribution to operating profit. Let's walk through one firm at one sales level to see how the pieces fit together. At 8,000 units, contribution is $3.2 million, and subtracting $2 million in fixed costs leaves operating profit of $1.2 million. Dividing contribution by operating profit gives a degree of operating leverage of about 2.67, meaning every 1% change in sales should move operating profit by roughly 2 2/3%. The fixed costs act like a lever nearly 3 units long, magnifying small sales changes into much larger profit swings. Raising sales 10% to 8,800 units pushes operating profit up about 26.7%, almost exactly matching the 2.67 leverage figure times the 10% gain. A leaner competitor selling the identical part at the same price and variable cost, but with far lower fixed costs, earns the same contribution yet a much larger operating profit. That shrinks its contribution to operating profit ratio, so the same 10% sales gain lifts its profit far less dramatically. The lesson, degree of operating leverage equals contribution divided by operating profit, and a heavier fixed cost base drives that ratio, and the resulting profit swings higher. Question 35. A bakery chain replaces its manual mixing stations with an automated production line, raising fixed costs through equipment depreciation while lowering the variable labor cost per loaf. Holding sales constant, what happens to its operating break-even point and its business risk? Your options are A. Both the break-even point and business risk fall. B. The break-even point falls, but business risk rises. C. Neither changes because total cost is unaffected. D. The break-even point rises and business risk rises because the cost structure is now more heavily fixed. Before I reveal it, which one do you think is right? The correct answer is D. The break-even point rises and business risk rises because the cost structure is now more heavily fixed. D is correct because shifting costs toward fixed raises the operating break-even point, since more units must be sold to cover the larger fixed base, and it raises the degree of operating leverage, which increases business risk. EBIT now swings harder in both directions as sales move. A is wrong because a larger fixed cost base raises the break-even point rather than lowering it, and higher operating leverage raises business risk rather than reducing it. B is wrong because the break-even point rises, not falls, when fixed costs grow. More contribution is needed to cover the bigger fixed base. C is wrong because total cost at a given volume is not the issue. The shift in the mix toward fixed costs changes both the break-even point and the firm's operating leverage, even if total cost looks similar. A purely operational choice, like automating production, can quietly rewrite a firm's risk profile without touching how it's financed at all. Trading variable labor for fixed equipment lowers the cost per unit, but raises the fixed cost base, pushing the break-even point higher. With more costs fixed, operating profit now swings harder in both good quarters and bad ones, which is a higher degree of operating leverage and more business risk. Picture a bakery chain ripping out manual mixing stations for an automated line. Heavy fixed depreciation replaces per loaf labor cost, so the chain now needs to sell more loaves just to break even. If demand stays strong, that automation looks brilliant. If demand softens, the fixed depreciation becomes a burden, and none of this required borrowing a single dollar or issuing shares. Any swap of variable cost for fixed cost, whether automation or capital-intensive production, raises operating leverage and business risk purely through operations, wholly separate from the financial risk that capital structure governs. Question 36. An all-equity firm decides to finance part of its assets with debt for the first time. The additional risk this places on the firm's common shareholders, layered on top of its existing business risk, is called what? Your options are A. Business risk, B. Financial risk, C. Operating risk, D. Market risk. What's your answer? Commit to one before I continue. The correct answer is B. Financial risk. B is correct because financial risk is the additional risk placed on common shareholders as a direct result of financing part of the firm's assets with debt or other fixed charge financing. It sits on top of business risk rather than replacing it. A is wrong because business risk is the risk of the underlying operations assuming no debt. The risk added specifically by taking on debt is financial risk. C is wrong because operating risk is another name for business risk, tied to the cost structure and operations, not to the decision to use debt. D is wrong because market risk refers to broad, economy-wide movements affecting all securities, not the firm-specific risk added by choosing to borrow. Let's look at financial risk from the seat of a common shareholder, watching what happens to profit once a firm takes on debt. Financial risk is the additional risk placed on common shareholders because the firm finances part of its assets with debt or preferred stock. It doesn't replace business risk, it piles on top of it, and it grows with every fixed charge the firm adds. The mechanism is concentration. A fixed charge skims a constant amount off the top, before shareholders are paid. So what's left for them is smaller and swings more in percentage terms. Financial risk doesn't touch the underlying business. It doesn't change demand for the product, the cost of input, or the firm's pricing power. The operating business is identical with or without debt. A levered firm's shareholders feel magnified gains and losses compared to an all-equity firm, even though the business itself is no riskier. Their position behind a fixed charge is what makes the difference, and that's financial risk made visible. Question 37. A firm is financed entirely with equity and carries no debt. What is its degree of financial leverage, and what does that imply about how EBIT changes flow through to EPS? Your options are: A. Its DFL is 1.0, so a given percentage change in EBIT produces the same percentage change in EPS. B. Its DFL is 0, so EPS never changes regardless of EBIT. C. Its DFL is greater than 1.0, so EPS changes are magnified. D. Its DFL cannot be calculated for an unlevered firm. Pick one, trust your gut, here's your chance to test yourself. The correct answer is A. Its DFL is 1.0, so a given percentage change in EBIT produces the same percentage change in EPS. A is correct because with no interest expense, the degree of financial leverage equals EBIT divided by EBIT, which is exactly 1.2. A DFL of 1 means EBIT changes flow through to EPS 1 for 1, with no magnification. B is wrong because a DFL of 1, not 0, applies to an all-equity firm. EPS does change with EBIT, it simply changes by the same percentage rather than a magnified one. C is wrong because magnification requires fixed interest charges. With no debt, there is nothing to magnify EPS, so the DFL is 1, not greater than 1. D is wrong because the DFL is perfectly well defined for an unlevered firm. With interest of 0, EBIT divided by EBIT gives a DFL of 1. Why does a debt-free firm always have a degree of financial leverage of exactly 1? The answer falls straight out of the definition, and it reveals what leverage really means. The degree of financial leverage is operating profit divided by operating profit minus interest. With no debt, interest is 0, so the top and bottom match, and the ratio collapses to exactly 1. A degree of financial leverage of 1 does not mean earnings never change. That would be 0. It means earnings move by the exact same percentage as operating profit, 1 for 1. Picture an all-equity firm whose operating profit climbs 20%. Its per-share earnings climb the same 20%. A levered twin with the identical operating gain would see per-share earnings rise by even more, because its fixed interest charge acts as a lever. Lock this in. An unlevered firm has a degree of financial leverage of 1, meaning operating profit changes pass through to per-share earnings undistorted, the clean baseline against which every levered firm's amplification is measured. Question 38. A firm has a EBIT of $1,200,000 and annual interest expense of $240,000. What is its degree of financial leverage at this EBIT level? Closest. Your options are A. 0,1. B. 100. C. 1,5. D. Wat valt? Which would you go with? Lock it in before the reveal. The correct answer is C. 1.5. C is correct because the degree of financial leverage equals EBIT divided by EBIT minus interest. That is $1,200,000 divided by $1,200,000 minus $240,000, or $1,200,000 over $960,000, which is 1.25. Is wrong because 0.8 inverts the ratio, dividing EBIT minus interest by EBIT. DFL puts EBIT on top, so the value is above 1, not below it. B is wrong because 1.0 would mean no interest expense. This firm pays $240,000 of interest, so its DFL is above 1. D is wrong because 5.0 would require interest much closer to EBIT, leaving a tiny denominator. Here the denominator is $960,000, giving a DFL of 1.25. The degree of financial leverage measures how sharply per-share earnings react to a change in operating profit. Its formula is simple: operating profit divided by operating profit minus interest. The interest in the denominator does the work. Subtracting that fixed charge from operating profit lifts the ratio above 1, and the larger the interest relative to operating profit, the bigger the lift. With zero interest, the ratio falls to 1, the all-equity baseline with no amplification. Consider a firm with operating profit of $1.2 million and annual interest of $240,000. The denominator becomes $960,000. So the degree of financial leverage is 1.2 million divided by 960,000, or 1.25. A 10% rise in operating profit becomes about a 12.5% rise in per-share earnings, the 10% scaled up by the 1.25 leverage. The same level works downward too. A 10% drop in operating profit produces roughly a 12.5% drop in earnings per share. Keep operating profit on top and the smaller after-interest figure on the bottom, never inverted. Any firm carrying debt will show a degree of financial leverage above 1, magnifying every operating profit swing into a larger swing in per-share earnings. Question 39. A firm has EBIT of $2,000 and a 25% tax rate. It carries $4,000 of debt at 10% interest and has 700,000 shares outstanding. What is its earnings per share? Closest? Your options are A. 240s, B. 171s, C. 250, D. 150. Don't overthink it. Which one feels right? The correct answer is B. 170. B is correct because interest is 10% of $4,000 or $400,000. Taxable income is $2,000 minus $400,000 or $1,600,000. After the 25% tax, net income is $200,000. Dividing by 700,000 shares gives about 171 per share. A is wrong because 2.14 skips the interest deduction. Dividing after-tax EBIT of $900,000 by 700,000 shares. Interest must be subtracted before tax. C is wrong because 2.50 does not match these inputs. It would require a much higher net income or far fewer shares than the figures given. D is wrong because 1.50 is the EPS, an unlevered version of this firm with 1,000,000 shares would earn, not the levered firm with interest and 700,000 shares. Let's isolate exactly what financial leverage does by financing the same firm two different ways. Holding operations fixed and changing only the capital structure. Under all equity financing, 200,000 shares split $900,000 of after-tax profit for $4.50 per share. Under the levered plan, interest of $240,000 cuts profit to $720,000, yet with only 100,000 shares outstanding. Earnings per share jump to $7.20. The buyback cut share count in half, and that reduction more than offset the drag from interest. This is the rocket booster effect. A smaller profit, divided among far fewer shares, produces a bigger number per share. Side by side, the two plans reveal the paradox. The levered firm earns less in total, but each surviving share captures a bigger slice, because the share count shrank faster than the profit did. But this edge is contingent on healthy operating profit. In a downturn, that same fixed interest charge would carve a deeper hole in the levered plan's earnings, reversing the advantage. So remember, leverage can lift per share earnings even as it lowers total profit, but only while operating profit stays comfortably above the interest bill. Question 40. When comparing an all-equity financing plan against a levered plan, analysts identify the specific EBIT level at which both plans produce exactly the same earnings per share. What is this EBIT level called? Your options are A. The operating break-even point, B. The degree of total leverage, C. The optimal capital structure, D. The EBIT EPS indifference point. Got a guess? Lock it in. The correct answer is D. The EBIT EPS indifference point. D is correct because the EBIT EPS indifference point is the EBIT level at which two different financing plans produce identical EPS. Below it, the less levered plan wins on EPS, and above it, the more levered plan wins. A is wrong because the operating break-even point is where EBIT equals 0, a cost structure milestone, not the EBIT level where two financing plans tie on EPS. B is wrong because the degree of total leverage combines operating and financial leverage into a sensitivity measure. It is not an EBIT level where two plans produce equal EPS. C is wrong because the optimal capital structure is the value maximizing debt equity mix, not the crossover EBIT level between two specific financing plans. Between any two financing plans, one with more debt and one with less, there's a single operating profit level where both produce exactly the same earnings per share. That crossover is called the indifference point. The levered plan carries a fixed interest charge that hurts at low operating profit, but it spreads earnings over fewer shares, which helps at higher levels. The unlevered plan avoids the interest drag, but divides earnings among more shares. As profit rises, the fewer shares advantage eventually overtakes the interest disadvantage, and at one exact point, the two plans tie. Picture the two plans as lines on a chart of earnings versus operating profit. Below the indifference point, the unlevered plan sits higher. Above it, the levered plan takes the lead. The indifference point only tells you which plan wins on either side of that level. It does not declare a plan superior, because a firm sitting above the point in a strong year has no guarantee. It stays there in a weak one. A boom can push a firm comfortably above the indifference point, tempting managers to favor the levered plan, but a recession can drag profit back below it, flipping the advantage. The indifference point never moves, only the firm's position relative to it does. Question 41. The degree of total leverage combines a firm's operating and financial leverage into a single measure of how EPS responds to a change in sales. How is it computed? Your options are A. By adding the operating break-even point to the financial break-even point. B. By subtracting DFA from DEL. C. By multiplying the degree of operating leverage by the degree of financial leverage. D. By dividing DOL by DFL. Which one is it? Pause the video if you need more time. The correct answer is C. By multiplying the degree of operating leverage by the degree of financial leverage. C is correct because the degree of total leverage equals the degree of operating leverage multiplied by the degree of financial leverage. It also equals the percentage change in EPS divided by the percentage change in sales, capturing both layers of leverage at once. A is wrong because break-even points are unit sales levels, and adding them does not measure how EPS responds to sales. Total leverage is a product of two sensitivity measures. B is wrong because total leverage multiplies the two leverage measures. It does not subtract one from the other. Subtraction has no meaning here. D is wrong because dividing DOL by DFL does not give total leverage. The two measures stack multiplicatively, so they are multiplied, not divided. Operating leverage and financial leverage don't work alone. They stack together, and the degree of total leverage is the single number that captures their combined punch. Operating leverage links sales to operating profit, and financial leverage links operating profit to per share earnings. Total leverage links sales all the way through to per share earnings in one step. And because the two magnifications apply in sequence, they multiply rather than add. A change in sales is first magnified into a larger operating profit change by operating leverage. Then that already magnified change is magnified again into per share earnings by financial leverage. Two magnifications applied in sequence. A firm with a degree of operating leverage of 2.5 and a degree of financial leverage of 1.25 carries a total leverage of about 3.1. A 10% sales rise lifts per share earnings by roughly 31% versus just 10% for an unlevered firm. And the same compounding amplifies losses just as faithfully as gains. When a scenario gives you both leverage figures, or total leverage and a sales change, multiply. Operating and financial leverage compound, not combine. And that compounding is neither good nor bad, just powerful. Question 42. A firm's degree of total leverage at its current sales level is 4.0. If sales decline by 6%, approximately what change in EPS should the firm expect? Your options are A decline of about 24%, B, a decline of about 6%, C, a decline of about 4%, D, a decline of about 10%. Take a second, which answer would you pick? The correct answer is A decline of about 24%. A is correct because the percentage change in EPS is approximately the degree of total leverage times the percentage change in sales. That is 4.0 times negative 6% or about a 24% decline in EPS. B is wrong because a 6% decline ignores leverage entirely. Total leverage of 4 magnifies the sales change fourfold, so EPS falls far more than sales. C is wrong because a 4% decline confuses the leverage multiplier with the result. The 4.0 must be multiplied by the 6% sales change, not used as the answer. D is wrong because a 10% decline does not follow from these inputs. Multiplying 4.0 by 6% gives 24%, not 10. Once you know a firm's degree of total leverage, projecting how a sales change hits per share earnings collapses into one multiplication. Total leverage times the percent change in sales gives approximately the percent change in per share earnings. The power of this shortcut is that it folds both layers of leverage into a single step. There's no need to trace the sales change into operating profit and then into per share earnings separately, since total leverage has already bundled the operating and financial effects together. Picture a firm with a total leverage of 4. A 6% drop in sales gets multiplied fourfold, producing roughly a 24% decline in per share earnings. And the same lever works just as powerfully in reverse on the upside. The errors here are errors of respect for the multiplier, reporting the sales change itself as the earnings change, or treating the leverage figure as the answer rather than as a multiplier. The discipline is simple. Multiply total leverage by the sales change and carry the sign. Per share earnings change equals the degree of total leverage times the sales change. A one-step projection that cuts both ways. Whether stress testing a downturn or modeling an upside, that single multiplication turns a modest sales move into the outsized earnings swing it drives. Question 43. Two financing plans, one less levered and one more levered, cross at their EBIT EPS indifference point. When the firm's actual EBIT sits above that indifference point, which plan produces the higher EPS? Your options are A. The less levered plan always produces the higher EPS above the indifference point. B. Both plans produce identical EPS at every EBIT level above the indifference point. So neither plan produces positive EPS above the indifference point. D. The more levered plan produces the higher EPS above the indifference point. Before I reveal it, which one do you think is right? . The correct answer is D. The more levered plan produces the higher EPS above the indifference point. D is correct because above the EBIT EPS indifference point, the more levered plan produces the higher EPS. The two plans tie exactly at the indifference point, and beyond it, the advantage tips toward more debt. A is wrong because the less levered plan wins below the indifference point, not above it. Above the crossover, more debt produces the higher EPS. B is wrong because the two plans produce identical EPS only at the indifference point itself, not across the whole range above it. Beyond that point, they diverge. C is wrong because sitting above the indifference point does not imply negative EPS. Both plans can be profitable there. The more levered one simply earns more per share. We found the indifference point between two financing plans. Now let's understand the rule that governs which plan wins on each side of it and why the winner can flip. Above the indifference point, where operating profit is high, the more levered plan produces higher earnings per share. Below it, the less levered plan wins. At the point itself, the two tie exactly. The switch happens because two forces fight inside the levered plan: a fixed interest charge that drags earnings down, and fewer outstanding shares that boost earnings per share. Which force dominates depends on how high operating profit is. At low operating profit, the fixed interest charge eats a large share of thin earnings, so the levered plan falls behind. At high operating profit, that same charge is a small bite, and spreading ample profit over fewer shares pushes the levered plan ahead. A firm above its indifference point looks great with leverage, but that advantage is conditional. The moment a downturn pushes operating profit below the crossover, the rule reverses, and the levered plan starts posting the lower earnings per share. Question 44. In a strong year, a levered plan produced higher EPS than an unlevered plan for the same firm, but in a later recession, the levered plan produced the lower EPS of the two. What best explains this reversal? Your options are: A. The firm quietly changed its number of shares between the 2 years. B. The fixed interest charge that boosted EPS when EBIT was high became a heavier drag once EBIT fell far enough, flipping which plan looked better. C. Business risk rose in the recession, which lowered the levered plan's EPS. D. The tax rate must have increased sharply during the recession. What's your answer? Commit to one before I continue. The correct answer is B. The fixed interest charge that boosted EPS when EBIT was high became a heavier drag once EBIT fell far enough, flipping which plan looked better. B is correct because the same fixed interest charge that lifted EPS when EBIT was healthy takes a much larger bite once EBIT collapses. Below the EBIT-IPS indifference point, the ranking flips. So the levered plan that led in the good year trails in the downturn. A is wrong because no change in share count is needed to explain the flip. The reversal comes from the fixed interest charge interacting with a much lower EBIT. C is wrong because business risk reflects the operating side and is not what reverses the EPS ranking between two financing plans. The driver is the fixed financing charge, which is financial risk. D is wrong because a tax rate change is not required. Even at a constant tax rate, a large enough drop in EBIT pushes the firm below the indifference point and flips the ranking. A financing plan that wins big in a strong year can lose badly in a weak one. The ranking of two plans is not permanent. It can flip entirely when operating profit falls far enough. The reversal traces to the fixed interest charge. When operating profit is healthy, that charge is small and easily absorbed. So the levered plan's smaller share count lifts its per share earnings above the unlevered plans. But when profit collapses, that same fixed charge devours a shrunken profit, dragging the levered plan's earnings below the unlevered plan's entirely. The asymmetry is sharper than a simple flip. The same fixed charge that magnified gains on the way up magnifies losses on the way down. So a given percentage drop in operating profit produces a steeper percentage drop in the levered plan's per share earnings. This is driven entirely by the indifference point, the operating profit level where both plans produce equal per share earnings. Above it, the levered plan leads. Below it, the levered plan trails and trails badly. The lesson is not to treat leverage as an unmixed benefit. A plan that flatters earnings in a boom has, in the same stroke, signed up for steeper declines in any bust. The benefit and the harm are two faces of one fixed charge. Question 45. A firm's degree of financial leverage at its current EBIT level is 1.4. If EBIT falls by 20%, approximately what change in EPS should it expect? Your options are A decline of about 28%, B, a decline of about 20%, C, a decline of about 14%, D, a decline of about 1.4%. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is A decline of about 28%. A is correct because the percentage change in EPS is approximately the degree of financial leverage times the percentage change in EBIT. That is 1.4 times negative 20%, or about a 28% decline in EPS. B is wrong because a 20% decline ignores the magnifying effect of leverage. A DFL above 1 means EPS falls by more than EBIT, not the same amount. C is wrong because a 14% decline is smaller than the EBIT change, which is the wrong direction. Leverage above 1 amplifies the drop rather than shrinking it. D is wrong because a 1.4% decline confuses the multiplier with the result. The 1.4 must be multiplied by the 20% EBIT change, giving 28%. Financial leverage oscillates one narrow question. Given a change in operating profit, how much larger a change lands on per share earnings? Purely because of the firm's financing? The degree of financial leverage times the percent change in operating profit gives approximately the percent change in earnings per share. A DFL of 1.4 means earnings per share move about 1 4/10 times as far as operating profit, because the fixed interest charges concentrate any change onto a smaller residual left for shareholders. Because the interest charge is fixed, it doesn't shrink when operating profit falls. So the entire decline is absorbed by a smaller residual left for shareholders, which is what stretches a 20% operating drop into a 28% earnings drop. This symmetry is the whole point. The same 1.4 that turns a 20% operating profit gain into a 28% earnings gain turns a 20% loss into a 28% loss. Financial leverage doesn't favor the upside. It magnifies whichever direction operating profit moves. When a scenario gives you a degree of financial leverage and an operating profit change, multiply and keep the sign. That single step translates the operating swing into the larger earning swing the firm's debt produces. Question 46. Across a wide range of debt ratios, a firm's expected EPS tends to keep rising as it takes on more debt, at least up to a point. Which pair of reasons best explains this? Your options are A. Interest is not tax deductible and a larger share count spreads risk. B. The cost of equity falls as debt rises and dividends become mandatory. C. Debt proceeds used to retire shares shrink the share count so income is divided more favorably, and interest is tax deductible. D. Business risk falls as debt rises, which automatically lifts EPS. Which would you go with? Lock it in before the reveal. The correct answer is C. Debt proceeds used to retire shares shrink the share count so income is divided more favorably, and interest is tax deductible. C is correct because when debt proceeds fund a buyback, the share count shrinks. So a given net income is divided across fewer shares, lifting EPS. The tax deductibility of interest adds a second boost. Together they push EPS higher across a wide range of debt ratios. A is wrong because interest is tax deductible, not the reverse, and a larger share count would lower EPS rather than raise it. Both halves of this option are wrong. B is wrong because the cost of equity rises with debt, not falls, and dividends never become mandatory. Neither claim explains rising EPS. D is wrong because business risk does not fall as debt rises. It is unaffected by financing. What rises with debt is financial risk, so this reasoning is incorrect. Across a wide range of debt levels, adding more debt tends to push a firm's expected earnings per share higher, driven by two distinct forces. The first force is share count. Debt-funded buybacks shrink the number of shares, so the same income gets divided among fewer owners. The second is the tax shield. Deductible interest lowers taxes, leaving a bit more after-tax income for those remaining shares. Think of it as a smaller pie cut into far fewer slices. Net income falls a bit because interest comes out first, but the share count falls proportionally more, so each remaining slice, each share gets bigger. Picture a firm stepping its debt ratio up in stages, funding a buyback at each step. Per share earnings tick higher every time because shares keep shrinking and the tax shield keeps widening. But a manager watching only that rising number might mistake it for a rising firm, ignoring the risk climbing right alongside it. Per share earnings truly are climbing, but that figure alone says nothing about risk or share price, which is exactly what the sharp reader asks next. Question 47. As a firm loads on more and more debt, shareholders demand a higher return to keep holding the now riskier stock. What is this rising required return on the stock called, and why does it climb? Your options are A. The cost of debt, which climbs because lenders face more default risk. B. The cost of equity, which climbs because more debt raises the financial risk borne by shareholders. C. The dividend yield, which climbs because payouts are legally required to rise with debt. D. The tax shield, which climbs because interest is deductible. Don't overthink it. Which one feels right? The correct answer is B. The cost of equity, which climbs because more debt raises the financial risk borne by shareholders. B is correct because the rising required return on the stock is the cost of equity. It climbs because heavier debt increases the financial risk shareholders bear, and they demand more compensation for holding a more volatile residual claim. A is wrong because the cost of debt is the return lenders require, not the return shareholders require. The question asks about the return demanded on the stock, which is the cost of equity. C is wrong because dividend yield is not a required return that rises with risk, and payouts are never legally forced to rise with debt. This does not describe the effect. D is wrong because the tax shield is the tax saving from deductible interest, not a required return on equity. It does not describe what shareholders demand. More debt does not improve a firm forever because shareholders are not passive about the risk it creates. As debt piles onto a thinner equity base, shareholders demand a higher return to hold the stock, and that rising required return is called the cost of equity. As a firm borrows more, its fixed interest charge concentrates every operating swing onto a shrinking equity base. Shareholders feel that added risk directly, and rational investors respond by raising the price they charge to hold the stock. At low debt, shareholders face mostly business risk and require a moderate return. As debt rises, financial risk thickens, earnings grow more volatile, and once debt is high enough to threaten real distress, the required return accelerates, with lenders raising rates in parallel. Borrowing lifts per share earnings, but it simultaneously raises the return shareholders demand, and these two effects pull in opposite directions on the stock's value. A higher earnings stream valued at a higher required return does not automatically mean a higher share price. Rising debt raises the cost of equity because shareholders demand more for greater financial risk. And this acceleration, once the stress threatens, is the force that eventually offsets and overwhelms the per-share earnings benefit of debt. Question 48. As a firm increases its debt ratio step by step, its expected EPS keeps climbing across the whole range, yet its estimated share price rises at first, peaks at a moderate debt level, and then falls even while EPS is still rising. Why does share price peak before EPS does? Your options are: A. Share price is unrelated to EPS, so their peaks are simply coincidental. B. EPS stops mattering to investors once any debt is added. C. Regulators cap the share price once debt passes a set threshold. D. Rising debt keeps raising the cost of equity, and past a point that rising required return outweighs the benefit of higher EPS, pulling price down while EPS still climbs. Got a guess? Lock it in. The correct answer is D. Rising debt keeps raising the cost of equity, and past a point that rising required return outweighs the benefit of higher EPS, pulling price down while EPS still climbs. D is correct because share price reflects both expected earnings and the risk-adjusted return used to value them. The cost of equity rises across the whole range and eventually climbs fast enough to outweigh the still rising EPS. So price peaks and turns down before EPS does. A is wrong because share price is closely tied to EPS through the valuation of earnings. Their different peaks are not coincidental, they reflect the rising cost of equity. B is wrong because EPS continues to matter to investors. The reason price turns down is the rising required return, not that earnings stop mattering. C is wrong because no regulator caps share prices at a debt threshold. The peak and decline pattern comes from the rising cost of equity, not from regulation. Chart a firm's per-share earnings and its share price against rising debt, and a strange pattern appears. Earnings keep climbing the whole way, but price rises, peaks early, and then falls, even as earnings are still going up. Per-share earnings rise with debt because of the shrinking share count and the tax shield, climbing steadily far up the debt ladder. The cost of equity also rises with debt, slowly at first, then steeply as the stress looms. Share price weighs earnings against that required return, capturing the tug of war between the two. Picture per-share earnings climbing steadily from low debt all the way to very high debt, while share price rises only to a moderate debt ratio before declining. The two peaks land in very different places, and that gap is the whole lesson. Early on, the earnings effect leads. Cost of equity has barely stirred, so price rises with earnings. But past a moderate debt level, the cost of equity accelerates and outpaces the earnings gains. So valuing a still rising earnings stream at a fast rising required return produces a falling price. When earnings are still climbing but price has already turned down, that's not a contradiction. It's the pattern itself, since price alone accounts for the rising risk of debt. Question 49. A firm is choosing its target capital structure according to the value maximization principle taught in this domain. The firm should select the mix that does what? Your options are: A. Maximizes earnings per share. B. Maximizes total debt outstanding. C. Minimizes the cost of capital and maximizes the share price. D. Eliminates the firm's business risk entirely. Which one is it? Pause the video if you need more time. The correct answer is C. Minimizes the cost of capital and maximizes the share price. C is correct because the optimal target capital structure is the mix that minimizes the firm's overall cost of capital and thereby maximizes its share price. That is the value maximization goal, distinct from maximizing EPS. A is wrong because maximizing EPS is the classic trap. The EPS maximizing mix carries more debt than the value maximizing mix and is not the goal. B is wrong because maximizing total debt would push the firm past the point where rising risk destroys value. More debt is not the objective, the right balance is. D is wrong because business risk comes from operations and cannot be eliminated by a financing choice. Capital structure policy targets value, not the removal of business risk. Capital structure policy has one governing rule: maximize the firm's share price, not its per share earnings. Everything else in this topic exists to defend that single sentence. Per share earnings capture the benefit of debt but stay blind to its risk. Share price is different. It embeds both the expected earnings and the risk-adjusted return used to value them. Since the cost of capital is the blended return paid to all investors, minimizing it and maximizing share price describe the exact same condition. Picture the cost of capital as a U-shaped curve. It falls as cheap debt replaces expensive equity, then rises as risk mounts. Share price does the mirror opposite, rising then falling, and its peak lines up exactly where the cost of capital bottoms out. Imagine a manager who chases maximum per share earnings instead. They load on debt past the safe point, landing at a high, risky debt level with a depressed share price, because earnings keep climbing even after value has started to fall. The manager who instead optimizes for share price stops at the moderate debt level where value peaks, serving owners better than any earnings figure ever could. When a question tempts you with maximize earnings per share, remember, only share price truly accounts for risk. Question 50. A board proposes raising the firm's debt ratio from 30% to 70%, arguing simply that pro forma EPS would rise. As the financial analyst in the room, what is the most accurate response? Your options are: A. While EPS may rise, the added financial risk will likely raise the cost of equity enough to reduce the share price, which is the metric that actually matters. B. Agree at once, since EPS is the only figure shareholders care about. C. Object that raising debt has no effect on the firm's financial risk. D. Insist that capital structure can never be changed once it is set. Take a second. Which answer would you pick? The correct answer is A. While EPS may rise, the added financial risk will likely raise the cost of equity enough to reduce the share price, which is the metric that actually matters. A is correct because the correct response recognizes the EPS versus price trap. Higher debt can lift EPS while raising the cost of equity so much that share price falls, and share price, not EPS, is the goal of capital structure policy. B is wrong because EPS is not the only figure that matters. A move that raises EPS but lowers share price destroys shareholder value, so blind agreement is wrong. C is wrong because raising the debt ratio sharply increases financial risk. Claiming no effect on financial risk is simply false. D is wrong because capital structure is a policy management can revise. Deliberate actions such as issuing debt or equity change the mix on purpose. So the claim that it can never change is wrong. More debt can boost per share earnings, so it must be good for shareholders, right? That tempting logic is exactly the trap a sharp analyst learns to catch. The flaw isn't that earnings per share can rise with more debt, they often do. The flaw is assuming higher earnings automatically means a better outcome for shareholders. Raising the debt ratio lifts per share earnings through fewer shares outstanding and the tax shield. But it also raises financial risk, pushing up the cost of equity that shareholders demand. If that rise in required return outweighs the earnings gain, the share price falls even as earnings climb. Picture it visually. Debt pushes earnings up, but it also pushes the cost of equity up. Only when we weigh both forces against each other can we tell what happens to the share price. And share price is the number that actually decides shareholder wealth. So when a boardroom pitch leans only on rising per share earnings, the sharp answer isn't agreement or denial. It's shifting the test to share price, weighing the earnings gain against the added cost of equity the debt provokes. And that completes our practice question review of Domain 1, Capital Structure and Leverage. Once you're ready to put this material to the test, just click the link in the description. It'll take you straight to our website where hundreds of free practice questions and complete study guides are waiting for you. There's no cost involved, so feel free to dig in whenever you're ready to explore the topic more deeply and sharpen your understanding. Be sure to subscribe so the next set of questions reaches you, and good luck on your Financial Management II exam.